The DeFi space is all about risk versus reward. Those that are willing to take on more risk are generally rewarded with greater returns and vice versa. However, that risk is sometimes hard to quantify and compartmentalize. You have to constantly be on the lookout for those hot projects and then weigh up the risks versus those rewards, potential yield versus losses. The problem is, these are not always known and clearly defined. So, wouldn't it be cool if there was a way to not only isolate that risk, but also standardize and tokenize it? Make it easy to understand and trade? Well, yes there is. And it's a brand new DeFi protocol called BarnBridge. And in this video, I'm going to be giving you an in-depth look at one of the most exciting DeFi projects currently in the space. By the end of this, you will know everything about the project background, the underlying tech, the use cases, and the tokenomics and price potential. Oh, and I'll also be showing you how you can get involved in some of that early bond token yield farming, so you won't want to miss that. Before I get cracking, I gotta do a bit of yapping. Yes, this ain't financial advice, folks. It's just me, a guy on YouTube, literally, giving his views and personal opinions. So, please do your own research and make sure you consult your financial advisor before diving into these waters. Now, if this is the first time that I'm gracing your screens, allow me to do the honors. My name is Guy, and over here at the Bureau, I spend all day and all night shaping top-notch crypto content, from guides to reviews and general overviews. So if this is something that's up your alley, then fire up that subscribe button and turn on all those notifications. That way, the YouTube overlords will let you know the moment that I release one of my videos. And finally, timestamps are below right over here. They are there for your convenience, so please feel free to jump around if you're strapped for time. Alrighty, ladies and gents, let's storm the barn. So, what is the BarnBridge? Well, it's a cross-platform protocol for tokenizing risk. That is the simple explanation. More specifically, it's a fluctuating derivative protocol that aims to reduce the risk of digital assets and digital asset yield sensitivity by breaking them down into small pieces, what are termed tranches. These different tranches can then be separated and bought by DeFi investors. BarnBridge is essentially smoothing out the risk curve. So essentially, they are developing derivatives that investors can purchase in order to eliminate some of the uncertainty that surrounds DeFi yields and token price volatility. Initially, the protocol is starting out with two products. These will be smart yield bonds that will aim to eliminate that interest rate volatility. Then they also have smart alpha bonds, which won't be tranching the yield instruments, but rather various levels of price exposure through the tokens themselves. I'll cover this later on. BarnBridge was initially conceived about a year and a half ago, just as projects like MakerDao were starting to pick up interest. This was a time when the total value locked, TVL, in DeFi was just below $500 million. Yep, crazy to think that this was just over a year ago when we have over $11 billion locked now. So yes, BarnBridge is not just a fly-by-night project that popped out of nowhere. In fact, there's a little bit of background to this story. For those of you who know the Synthetics founder, Kane Warwick, he was first approached by the team back in August, who pitched him the idea of risk tranches in the Synthetics pool. Long story short, he was so damn impressed with the progress that the team had made on building the protocol that he was dying to invest. This is exactly what he did as an early-stage investor and advisor. You can also count the founder of Aave on that list. Of course, they were backing a pretty accomplished team. This lot had worked on numerous high-value projects in the past and were well known in the community. So, no Chef Nomi escapades over here. Despite the amount of early-stage interest there no doubt was in BarnBridge, the team only raised seed funding of $1 million. This was just the amount they needed to build out the protocol. No need for those multi-million-dollar ICOs. They prefer to give out 68% of their token supply through community incentive schemes. More on that later. Okay, so This is a bit of an intro. However, in order to best understand how it works, we have to take a look at the concept of tranching fixed income instruments. It is definitely not unique to DeFi. Packaging debt instruments and then slicing them into different tranches is a concept which has been used in traditional finance for a number of years. The correct term is a collateralized loan, debt, or mortgage obligation, CLO, CDO, CMO. These are all basically single securities that are backed by a pool of debt. It could be corporate debt, mortgage debt, or other types of loans. These are then easy to sell on as a single security because they've been securitized. These CLOs are then broken down into a number of different chunks that are referred to as the tranches. These tranches are based on the risk profile of each tranche. You have the senior, more secure tranches at the top who have the first right to income. They usually have a fixed rate of return that will be paid first from all of that income coming from the CLO. Then, of course, you have the subordinate tranches who earn what is left after the senior tranches have been paid. In some cases, if there's a lot of excess returns above what is expected, the subordinate tranches will be the ones that get that. Of course, it also works the other way around. When there are any losses on the tranche, the subordinate debt will take it first. Moreover, senior fixed income rates have to be paid first before the junior tranches do. This means that there may not be any income for those junior tranches once the senior debt has already been paid. So, what you have is a situation where the subordinate tranches are taking on more risk for more potential reward. You have taken a pool of otherwise arbitrary fixed income securities and easily packaged and syndicated it. Investors can choose the risk level that they're comfortable with and then invest in that tranche only. Of course, I should point out that the CLO is only as good as the loans and debt securities that are being packaged into it. If there is a lot of junk in there that's mispriced, then there is a risk that even senior levels of the tranche could face losses. In fact, this is exactly what happened in the subprime mortgage crisis of 2008. Okay, so now you have an idea of how a CLO works in traditional finance. However, there is no reason that this concept cannot be applied to crypto yield generating tokens. In fact, it's perhaps even easier. And this is where BarnBridge comes in. We all know that there are a lot of DeFi protocols that pay interest on the funds that are locked into them. This therefore makes them a debt instrument with a variable market-driven interest rate. We can easily just pool these various interest-generating tokens into one security and tranche it out. You can tokenize that senior tranche and allow people to buy it for a fixed rate of interest. You could of course do it for the more junior tranches and allow them to benefit from residual interest and take more risk in case of losses. There are benefits of this over your traditional CLO, of course. Firstly, it's all transparent. You can see exactly what lending protocols the CLO is investing in. Part of the reason that CLOs had such a bad rap in the subprime mortgage crisis is that they were opaque and no one really knew what was in them. Another benefit of tokenized over securitized is that it's much easier to do. No need for lengthy prospectus documents, investment bankers, originators, and other financial intermediaries. All you need is a smart contract, and it can be done in a permissionless and automated fashion. This, of course, saves fees and hence increases returns. One final reason that this is preferred is that it is, of course, quite liquid. By tokenizing risk, you're creating an ERC20 token that can easily be traded and exchanged. Storage is also done easily and in an immutable fashion. So, one can no doubt see the appeal from pooling, tranching, and tokenizing cryptocurrency debt. And that is what BarnBridge have done with one of their first products, Smart Yield. Smart Yield is an instrument that is designed to remove the interest rate risk component from crypto debt instruments. You see, currently, the decentralized financial system is primarily offering variable rate annuities. This means that investors have no certainty around the interest rate that they can get on their deposits. However, by pooling locked crypto collateral into a fund and investing it in various different forms of crypto debt, Smart Yield is able to structure fixed rate debt instruments. These fixed rate tranches can be seen as analogous to those senior versions I talked about earlier. They'll receive their fixed rate of interest before any other holders are paid. Then the more risky and junior holders will get a variable rate that will depend on the amount of residual interest from the debt pool. Could be large or small, depending on how much interest was earned over the entire pool. Okay, I think this all calls for an example. They have provided this handy schematic over here that easily explains the process for you. Users will purchase these tokens over here that will represent different risk tranches in the pooled debt instrument. They will buy these tranches with DAI. The DAI is then pooled and is used to supply loans to the Compound ecosystem. As we know, supplying DAI to Compound will get you CDAI, which are interest-generating tokens. These CDAI are then wrapped into those tokenized risk tranches that I mentioned. 70% of the tranche will be senior and the remaining 30% will be junior. In this example, the senior will get a 5% fixed interest rate and they will have first recourse to this. The junior tranche will then get whatever remains from the interest that's earned above that. This may be quite an attractive APY if the whole pool is doing well. That residual interest can be juicy. However, if there's not enough interest generated in the pool to pay the senior tranches, then the junior will have to take some of those losses. You can see what that looks like over here. What this all means, therefore, is that you have an effective method to separate out the variable interest rate volatility and allocate it to the junior tranche. They're securing the senior tranche, which is able to earn a defined rate of interest. Risk has been tokenized. Oh, and by the way, this example was just for Compound, but there are a number of other DeFi protocols that they are considering using. These include the likes of MakerDao, Aave, Synthetics, etc., etc. Now, this is the primary product that will be offered at BarnBridge, but they're also developing another one called Smart Alpha. So, shall we take a look at that? Unlike smart yield instruments, where volatility comes from the interest rate on crypto loans, with the Smart Alpha bonds, volatility will come from the movements in the underlying price of crypto assets. Instead of coming from tranched crypto debt, it will come from tranched volatility derivatives. The BarnBridge team are calling these risk ramps. Okay, so I know this is a bit of a mouthful, but if you look at an example, it's much easier to understand. Let us assume that just in the case of the smart yield instruments above, we've pooled funds and then split them up into those risk tranches. However, the return here is generated from an increase in the price of ETH and not crypto interest. So, let us assume that the price of ETH upon inception is $500. It then subsequently moves down to $400. In this case, the losses from the fall in price will be disproportionately apportioned to the junior tranches. However, it also works on the upside. If ETH ends up moving considerably above $500, then the junior tranche will get rewarded way more than the senior tranche. So, what's happening here is that you're basically pooling funds and tokenizing out those different risk ramps. Or, to use a simple example, the junior tranche can be thought of as being more levered to the price move than the senior tranche. It's really pretty mind-blowing if you ask me. Oh, and by the way, if any of this is unclear to you folks, feel free to fire a question into the comments and I will try to get back to you. I've also linked to their docs in the description. Okay, so those were the two initial products that they will be offering, and they are no doubt interesting. But there is much more to this project, and central to it is, of course, the BarnBridge DAO and that bond token. What's really important to know about BarnBridge is that they had a pretty fair launch. In fact, they've called this their DAO first launch, as the protocol will not be controlled by a company at any stage. Instead, BarnBridge will be a protocol that will be completely governed by a DAO, or Decentralized Autonomous Organization. This will initially start as the launch DAO, which is controlled by the founders, seeders, and advisors. However, the goal is to eventually transition this to the BarnBridge DAO, which will be the DAO controlled by the bond community. The BarnBridge DAO will have full control over the protocol and the features that are built into it. Of course, central to this BarnBridge DAO is, of course, that bond governance token. This is an ERC20 token that will have a total supply of 10 million tokens. Not only will the governance be fair through a DAO, but you'll also have a relatively fair token distribution. In fact, if you take a look at the token distribution over here, you can see that a full 68% of all bond tokens will be distributed to the community through a number of initiatives. I'll cover this in a bit. You also have a fair and prolonged vesting schedule for those tokens that are coming from the founders, seed investors, and advisors. So, no major cliffs of token releases that could lead to dumping. Now, these bond tokens are central to the governance mechanism as they're used in order to take part in voting for proposals. Bond tokens are an ERC20 token and there will be a 10 million token initial supply. Apart from the voting component, these tokens will also be used to stake on the network and earn additional rewards. Now, while it's hard to place an exact dollar value on each of those use cases, we know that there is a hell of a lot of demand for governance tokens. A demand to be a part of a decentralized protocol that's governed by the community. And this is not just about voting. There are plans in the pipeline to eventually release smart contracts governed by the DAO, where users can define what they would like the core contracts to do. So, yeah, there is going to be a hell of a lot of demand for these tokens. Actually, there is a ridiculous amount of demand now. You only need to look at the fact that 2 days into the release of their yield farming initiatives, over $200 million was locked into the protocol. And this is now a perfect opportunity for me to segue into that topic. Like most other DeFi protocols out there, BarnBridge is looking to bootstrap their liquidity with community incentives. This also fits in with their goal of an equal distribution of those bond tokens to the community. The first initiative available to the community was that yield farming component, where 8% of the total supply was distributed to those who staked DAI, USDC, and SUSD. These stablecoins were chosen because they will serve as the initial set of yield-producing assets on the blockchain. So, for those of you who are familiar with staking terminology, these will be released every epoch. An epoch lasts for 1 week, and there will be 25 weeks when this will run. So, this means every week we will have 32,000 bond tokens released. We just had our first release a few days ago. Now, there is of course another way that users can earn these bond tokens, and that is through liquidity mining. They have called this their liquidity pool incentivization, and they reward those users who've been providing liquidity for a longer period of time with progressively more power over the ecosystem. Here you will have to supply liquidity to the bond USDC pool over at Uniswap in order to get liquidity pool tokens. Once that's done, you will have to withdraw these and then stake them over at BarnBridge. This program will start 1 week after those yield farming initiatives I mentioned. It will run for 100 weeks with 20,000 tokens being distributed every week. In total, 20% of the total supply of bond tokens will be earned in this LP incentivization phase. So, not only will you have an opportunity to earn bond tokens in the initial yield farming phase, but if you use those bond tokens in order to provide additional liquidity for them, you'll earn even more. Sounds like a pretty sound model to me. And if you've seen how crazy the market has gone for previous governance tokens, there is nothing saying that Bond won't generate similar amounts of interest. Now, of course, if you're thinking of farming some of those Bond over the next few weeks, you do need to be aware of the risks that come from yield farming. So it is important for me to quickly go over some of these so you folks don't YOLO in head first. Firstly, you are locking up capital in a pool for a defined period of time, which does leave it exposed to certain risks. Yes, there is the risk of what is termed a rug pull. These are when a project exits scams and takes all of the tokens with them. Now, I personally think this is highly unlikely that BarnBridge will fall into this category. This is mainly because of its transparency. Many of the developers working on the protocol are well known in the space, and, as mentioned earlier, they have well-known investors backing the project. Then, another risk that you face with yield farming is, of course, smart contract bugs and hacks. These have also happened at a number of other protocols, and they are those black swans that we have to be careful of. At BarnBridge, they have conducted both an internal audit and an external audit by the Hacken team. The risk is still there, but of course, audits do help. The final risk from yield farming is a lesser known one, but is no doubt a pressing issue. This is, of course, impermanent loss. This is basically the risk that comes from not being in control of your allocation to the pools. You can view it as an opportunity cost of not holding the tokens in a 50-50 split. I've covered it in much more depth in my video on DEXs, which you can watch right over here. At BarnBridge, you don't really face the risk of impermanent loss in the first pool of stablecoins. This is because they are stablecoins and are hence always equivalent. Yes, if one of the coins does break the peg, then there is a slight loss, but pegs generally return to 1. The second pool that will open up on Uniswap has more risk. This is because you'll be providing liquidity between USDC and bond tokens. While USDC is stable, you are exposed to bond price volatility. You also have no control over how many tokens you are holding between the two pools. These are down to market conditions like volume and bond price volatility. So, it's important that you know that the second liquidity mining pool on Uniswap is more risky than pool 1. You can read more about this in the BarnBridge blog post on the risks, linked to below. It's time to start wrapping up this video, folks, as I'm sure you all want to get on with your lives. So, here are a few of my final thoughts on the project. I will say that I am really impressed with the underlying functionality and features of the protocol. The idea of pooling and tokenizing risk is a novel one that's not been done in the crypto markets as of yet. It will allow users to invest in crypto debt that can not only get them a stable rate of interest, but also allow users to take on the risk that they feel comfortable with. While the concept of risk tranches is well known in the CLO space, with the use of transparent and secure smart contracts, BarnBridge has made it that much more simplistic and accessible. I'm also interested to see how those smart alpha bonds will look. These are a lot more complex than the simple smart yield instruments, but if the team can pull it off, they will no doubt appeal to many in the crypto space. Apart from the functionality, I do like the fact that they are running with a fair launch and a DAO-first approach. A community-governed ecosystem from the get-go. One where those who hold bond tokens will all share in the growth of the ecosystem. I think they also have a pretty compelling yield farming initiative. This is well evidenced by the sheer amount of funds that have been locked into the contracts. All of these humble farmers are lined up in the fields, ready to reap their bond harvest. Of course, as mentioned, there are risks here. The team never really expected the pools to be this large. And while it has been well audited, bugs can sometimes sneak through the woodwork. Also, you should be careful of that impermanent loss risk. No one knows what will happen to bond when it hits the market. There are a number of other DeFi protocols that have had governance tokens fall faster than a dodo in flight. So, yes, do be aware of the risks and weigh them up with the potential rewards. As for myself, I may allocate some capital to BarnBridge, and if I do decide to do that, then I will let you know about it in my weekly email. What's that? You haven't heard of my weekly newsletter? Well, you are in luck. This is my once-weekly take on everything in the crypto markets. This includes market trends, interesting projects, and general hints and tips. I also share the breakdown of my personal portfolio. So, hit that first link in the description to sign up right now and confirm your email, and you're locked and loaded. And that's it, Crypto Crew, my BarnBridge review. But now I need to hear from you. What are your thoughts on the project? And do you folks have any questions for me? Fire them into the description. Finally, thank you for sticking around. I hope you got real value out of this video. Don't forget to smash those likes on the way out, of course. And ping that subscribe button as you don't want to miss what else I have in store. It's gonna be oh so hot.